Subtle reminder that nothing we say on today's show should be construed as investment advice. Everyone listening should contact professional investment advice. Welcome back to the Loonie Hour, episode 4. We're here with my boy Richard Diaz with Acorn Macro Consulting, a boutique research firm covering the global macro with a number of institutional level clients. And our favorite boomer, as always, Keith Dicker with IceCap Asset Management, who's been managing money professionally for over 30 years, running a hedge fund, etc. Kind of a big deal. Welcome back to the show, gents.
Morning.
I love how I'm a boomer. What am I exactly as the boomer? Is it the Gen
I mean,
X?
you had troubles logging onto the Zoom here today, so
And you own a house.
So just to be clear, so I did the CFA program. I think I finished the last exam in '97. I think it was, but there was no email for us back then. There was no internet. Everything came in a big box of books and everything. So yeah, I guess I am a boomer.
Really showing your age there. I love it.
Yeah, I know, it's crazy. The internet, yeah.
But you look fantastic. Anyways, on with the show. So this week kind of wanted to do a little bit of a overview for my sort of longtime followers, so to speak, update on the Canadian housing market, because I think that's going to tie in well with the rest of the show, because we want to jump into, what's happening in the oil market in particular. Obviously, it's a huge resource here in Canada. But what we've seen obviously is a huge doubling down, I suppose, on housing, right? I mean, it's gotten such a large component of our economy. And so we're going to touch on that and how that plays into the oil market, and obviously what our government is proposing to do there. So, first and foremost, covering my hometown here, Greater Vancouver, home sales down 5% on a year-over-year basis. But the big story again here is inventory dropping 38%. Just a massive drop. I mean, home prices are now up officially across the board 15%. But there's all these aberrations that are happening. We've talked about this pandemic-driven flight to the suburbs. House prices in suburbs such as Abbotsford are up 35%, Langley 35%, Chilliwack 52%. So just massive house price inflation there. If you go to our nation's largest city, Toronto home prices as of the end of October now up 25%. Active listings contracted 55%. So not a whole lot of relief on the housing front. Despite all the narratives around rate hikes and inflation, et cetera, which kind of brings me to sort of framing up this week's podcast conversation. Everyone's talking about rate hikes. Obviously, we just talked about how large a component real estate is of the economy. Macquarie Macro Strategy, Macquarie put out a piece here. Canada's residential investment as a percentage of nominal GDP is now over 10% of nominal GDP, 4 standard deviations above the long-term average. So kind of goes to show you that, we've doubled down on housing. And I think the government, Rich, at the most recent meeting there of the global minds, proposing some harsh reality to the energy sector here in Canada. Do you want to touch on that?
Sure, but I just want to say, can I just touch one more thing on the housing? I think the corollary, and if you don't mind, but the corollary on that 10.3% of nominal GDP is that investment in other types of CapEx is basically at an all-time low as a percentage of GDP. So I think it's important to remember, it's not only that we're just investing and spending a lot of money on real estate and housing, is that we're not investing on any other part of the economy. And I mean, I have some charts I'm happy to share with our listeners offline, but it's just, it's down in real terms.
I don't know why you would start a business if you can just go buy a pre-sale and get rich. So
I think that's exactly
what doing.
But I mean, the other Keith can do it. I can do anything. Yeah. I mean, the other interesting part about that is, this rise in residential investment, it's all from debt. That's where it's coming from.
Yeah.
And a lot of CapEx comes from equity going into a business and a startup. And this has been ongoing now for a number of years. There's been a pretty big decline or trending downward trend in private capital wanting to make an investment in various industries. And it's not just in Canada, it's helping elsewhere as well. And, we go back to the whole central bank, sort of environment they've created. The closer and closer we trended towards 0% rates, that's when the private sector said, "Hey, this is a bit wacky right now. Let's hold back a little bit. Let's buy shares. Let's buy our shares back instead, and whatever." But it is a great observation, Rich, to tie that into it.
Yeah, so it's also just a function of Canada. I mean, we'll get into this in a little bit later, but it actually ties into the oil thing. Is that Canada just? I love Canada. So before, and I'm really proud to be Canadian, but I think it's important that we acknowledge sort of the realities. And I think that's, when we talk about the housing market and the issues there, we talk about CapEx and other sectors outside of housing and the issues there. I mean, the only way you can sort of correct for problems in your economy, in your life, and anything is for acknowledging the things that are going wrong with it. And how you do that is just looking at the raw data. And I think that's, when we think about how else would you improve a country's productivity, you have to look at things like real research and development. And again, I'm happy to share any of these charts with people, but these are widely available. R&D spend on natural science and engineering doubled from 1990 to 2005. And since 2005, and it's no coincidence that sort of is approaching the last peak in the oil and commodities, it's been flat. So just think about that. Spending on research and development for engineering and natural sciences has been flat in this country for 15 years.
Now I have a question for you. How much of that do you feel is directly attributed to Canada and just maybe us maybe losing our way, our business savvy, and how much of that do you think is attributed to sort of what appears to be like a global, like the financialization of the economy globally, right? Like, as Keith talked about, zero interest rate policy, private corporations opting just to do share buybacks, stuff like that, like this sort of financial engineering, because the cost of capital is essentially zero.
Yeah, I think it's two things. One, I think it's, we actually underestimate how negative, and this is my view personally, so forgive the editorial, but I think we underestimate how important or how bad the WTO was for countries like Canada, parts of the Midwest. And in effect, we no longer produce consumer goods. And I'll get to why this is really important when we touch on oil. We don't produce consumer goods. We don't really produce we don't manufacture cars really anymore. We have negative net exports, so we import many more cars than we produce. Although there's some big parts manufacturers in Ontario, electrical equipment, machinery, etc. Again, always happy to share the charts that I have on this data. But I think it's related to what Keith said. When you push down interest rates well beyond what they should be, e.g., negative real interest rates, and you stick them there, people are smart. Eventually, people just say, "Why get a job? Why invest in productive assets when I can just make the cap rate trade?" Right? The cap rate meaning, as you can explain this better than I can, Steve. But when interest rates go down, your return on your equity is fantastic.
I mean, can I just hop in there really quick? I mean, I think like I see it, at least like I'm just hearing you say this, like, oh, that sounds really familiar. I just see it like in the housing sector, it's like everybody and their dog wants to buy a rental property. So everybody's now becoming an investor in real estate. It's kind of just like a self-fulfilling feedback loop, right? Like the more that the prices go up, the more it entrenches this view that
it can never go down.
It can never go down. And so, yeah, it's like, why start a business, right? Like, let's just go long a pre-sale condo. And like what I talk to mortgage brokers, like, some of the biggest things that we're seeing, I'm talking like the best mortgage brokers in all of Canada. So they're doing so much volume. The biggest thing they're seeing is like what you would traditionally see in the housing space is, okay, you've got a entry level home, a condo, whatever. You typically would sell that, use the equity, and then upsize to your family home. Well, now what people are doing is they're keeping that existing condo, they're refinancing that, and then buying their family home. So they're opting to keep basically two properties. And so I think that kind of plays into basically what you just said.
Just one thing to add to us, because it does tie into our energy conversation that's coming up. The financial industry has always been able to react or be proactive very, very quickly. It can turn on a dime. So if there's an opportunity to lend into this market, capital will find its way there very quickly. That will lead into our energy market discussion. The energy market is different. When policies change and demand changes, things like that, that global industry, it takes a long time to turn. It's literally this enormous ship. It takes a while to turn. Sometimes it takes years for it to make that turn to respond to changes that are happening. And that's what Canada is. We have to have this bookend economy right now, the financial sector and the energy sector. That's how we move into the energy discussion.
Yeah,
so I think so. For me, I spent a lot of time looking at this because I love studying economies. I love understanding what makes countries tick. And I think what's important for our listeners, especially the Canadian listeners, is Keith's warned me to not make this political, and it's really important to not talk about climate change either, because that's not what this sort of discussion for me is about. What discussion is for me about is just simply for Canadians, I think, to understand the importance that oil is right now in our way of life, in our inflation, in our current account balance, and et cetera. So effectively, Canada is a natural resource extracting economy. We extract and use our natural resources and our land in order to pay for goods that are manufactured and produced everywhere else. So 50% of our exports are things like our energy, mining, agriculture, and basically chemicals, but that's partly a thing. And so just to be clear, our largest net export is energy products. That's 15% of our exports. And we sell energy, forestry, mining, materials, looking at this, to pay for those consumer goods. Our current account balance right now is in line, so it's zero. And that's a function of two things. One, the fact that Canadians no longer travel anywhere, so we're all stuck at home. That's a services component that has basically gone from massively negative to zero. But very importantly is that the energy exports component is 3% of GDP. Just to give you sort of into context, Germany, all of the euro area is an exporting nation. Its entire current account balance is roughly 3. And then if you X out that energy products, you have a massively negative current account balance. And I think that that's really, really important. We sell energy and a bunch of other stuff in order to pay for everything else. You say, well, Rich, what if we just stop producing and selling energy? Well, the reality is we haven't spent basically $1 on the infrastructure and the assets necessary to A, produce the things that we want to consume and buy, and B, to compete on a global market, which is what we do. What we have is natural resources, and we exploit those natural resources. So again, the last point, I'll flip it to you guys. The key thing there is we exchange. So the world basically consumes about 100 million barrels of oil per day. 1 barrel of oil is 42 gallons. It's about 159 liters of oil. Canada is the 4th largest producer of oil in the world. It varies from day to day who's in first. Right now, it's the US with about 11, Russia, 10, Saudi, 9. Then the next 4 are Canada, China, Brazil, and Iraq. Those 4 basically fight it out for who's in 4th place, but basically Canada with 4.4 million barrels of oil produced a day. 97% of those barrels get exported to America, which is why pipelines, by the way, there's loads and loads of pipelines already. So the effect that they're arguing about one is a joke. That is exported to the United States, which is our largest trade partner. So we exchange oil. They give us hard currency, US dollars, and we use that to keep our quality of life relatively very, very high. GDP per capita is very high. what that allows Canada to do is by exploiting that oil resource, it creates a shock absorber. How does it create a shock absorber? Our currency is tied inextricably to what's called the terms of trade. So when oil is a pro-cyclical commodity, when the world is improving, oil gets bid up. Our currency follows the price of oil. And so as the world improves, our currency effectively has a built-in shock absorber to increase our purchasing power of all of the goods and services that we purchase from countries like China and the United States, et cetera. And so this idea that Canadians can just extract themselves from this resource is possible, sure. But what for me is lacking in the conversation is a profound and deep understanding as to why it's important, given what Steve, you've talked about, which is the overdependence on real estate to our GDP and as a function of that, our lack of productivity.
Boom. That was a masterclass right there. I mean, I think that's, you've kind of hit the hammer on the head here. I mean, Keith, I'll throw it over to you in a sec here, but I think if everybody's talking in Canada about, hey, again, like I bring this back, like, hey, rates are going up, housing's going to blow up. Okay, well then what? Right? Like oil is like that, like saving grace. And like, so I don't know, we seem obviously hell bent on getting rid of it here in Canada, but I don't know, Keith, what are your thoughts?
Yeah, I think, I think we always had to be pragmatic about things. And, what Rich described, it's very important and critical for us to understand is how vital the energy sector is for Canada. Even if you're not touching Alberta or Newfoundland for that matter, it's extremely important for everyone. So
I forgot that part.
Yeah, it's and one of those, Alberta is considered to be a very dirty oil, and what it's the byproducts from getting it out, whereas the Newfoundland oil is not as dirty from that perspective. But I think first of all, what we need to appreciate here, a couple of things. First of all, is that as we mentioned earlier. So what's really interesting with the energy sector, it's affecting everyone in Canada. It doesn't matter if we're in Atlantic Canada or in Ontario or BC, but all the oil in Canada is being produced out of Alberta as well as Newfoundland. And what's important to know is that the Alberta oil, the oil sand, is considered to be dirty oil. The byproducts coming out are considered to be more harmful for the environment. Meanwhile, the oil coming out of Newfoundland is considered to be less harmful, for everything else being equal. Now, what we need to know are two things here. First of all, as I mentioned earlier, the global energy sector, it's incredibly complex. You can break it down by, you have oil, and then you have natural gas. And the problem with natural gas, of course, is transporting it. To get it from one continent to the next. You have to liquefy. It means you're putting on ships, and these ships are burning oil. The ships cannot burn anything but oil to move around. They can't run on solar or anything like that. So it's a very complicated system that we have. And then what we need to do next is place two other, layers on top of it. First of all, in terms of oil being produced in the world, the majority of the oil, it is coming from what you call national states or nation states. So you're looking at the Middle East, Saudi, and the Russians, and so forth. And then you have the private sector. And as Canadian investors, we tend to only focus on the private sector, and specifically, the Canadian listed energy companies and so forth. The other layer to wrap all this up nice and neat and tidy is that there's an extremely powerful, environmental industry around the world. And they are being funded by both public sector and private sector players. Some would be considered good, some would be considered bad. And they all have an incentive for doing this. But the point is, this group, they have a lot of influence on what politics are being played out and what policies are being implemented. So the policies that we're really talking about today, to cause us to be concerned about being Canadian and what could happen with the energy sector, it's coming from these global policies. And it's irrelevant whether you can agree or disagree with them. We say, hey, some of this data that's really frightening, or this data doesn't reconcile quite right. The point is, the momentum pushing these policies, it's coming straight down, going to go railroad straight through Canada, and it is going to affect our energy sector. And most specifically, it's going to have an impact in terms of what's going to happen with the price of oil. And when oil rises, it doesn't affect the middle to upper class as much. It does affect lower income families and individuals. And that's the same all the way around the world. I mean, you remember the Arab Spring from a few years ago? And like that was caused from food shortages primarily. And if we continue to go down this path of trying to create cleaner energy, that's going to have effect on fertilizer prices. They're going into food, and food prices are higher. For example, you look at what's happened in the UK now over the last few weeks. Is that exact same scenario playing out? So again, as Canadians, we have to appreciate, as investors maybe on the call, you think, hey, the price of oil is going to go up to the moon. It's going to be strong. I'm going to make lots of money here. The supply of oil is going to be dictated at the national level, not by the private sector. And the supply of oil should not change very much unless we get a geopolitical event. That's what would happen. But then we're switching over then to the private sector, and that's what we're thinking about as Canadians, Canadian investors. How can they position themselves? Can they get access to funding? And those are these are the type of decisions that were coming out of Scotland over the weekend. Did you guys read the Carney article that came out as well?
You want to just remind, give listeners a little tidbit on that.
Yeah, sure. So, so Mark Carney, of course, he's a good Goldman Sachs guy a long time ago.
Former Bank of Canada governor.
Then he went to the Bank of Canada for a while, and then he went to the BIS, or no,
Bank of
BIS.
England.
Yeah, the Bank of England, also the Bank of International Settlements, and now he's jumped over on the UN side. So I actually met him a few years back, and lovely guy. The point is, though, he's extremely well connected and respected, and again, so he's a part of this policy group that are driving these changes around the world. And one of the I don't know what the correct word to use is. The group that there's an acronym for it, but he now has all the world's major banks on side. So which include JP Morgan, Bank of America, everyone's favorite Canadian bank as well. They've all agreed that they are going to make it now more expensive for energy sector production companies to get capital, to borrow. That's what's going to happen.
They're basically starving them of capital.
Yeah, it's going to be difficult. So, we talked earlier about, the Canadian housing market. It's gone up because it's gone up, but also debt's gone up at the same time, right? So, one debt is being offset by the assets being reduced by the debt. So the net change, it's sort of incremental. With these energy production companies and exploration companies, if they're not able to borrow with debt from, say, they're smaller, Exxon is not borrowing from a bank, of course, right? They're going to regular debt markets. But, for the junior guys and the mid-tier up, it means they have to borrow equity. Not borrow, they have to acquire equity to do this. Equity comes from individual investors, private investors. We'll talk about the institutional space in a second. Let's talk about the institutional space first. So the institutional space, that will be pension funds and so forth. They are being highly driven by ESG investing, and they are being discouraged from investing in these sectors. So now all of a sudden you're going to have less investments on a regular basis going into the energy sector with passive funds and active funds and so forth. So then they have to acquire capital another way. So then they have to go, say, private equity, and that's quite expensive. And these investors know, because they can see this, this huge wave of policy changes on a global basis, supported by all the governments of the major countries, as well as these extremely powerful environmental groups, as well as this group that's collecting all the banks together. As a private investors, do you want to stand in front of that? That's a pretty bold stance to take. Rich does, of course. But the point is that there's a lot of things stacked against the energy sector right now. And, one of my friends, the guy Bob McMinn, if you ever come across Bob, but a couple of years ago, he introduced me to the idea of stranded assets. He said, Keith, hey, listen, stranded assets in the energy sector, it's going to happen. That's where we're going. So the point is that there's a lot of
can you just touch on that, stranded assets? Like what do you mean by that?
Yeah. So, for example, right now we all have friends in Alberta, and like some of my friends, they've had to leave. They've had to move to Houston. The big energy companies up there, some of them have simply stopped production on some of the properties or have stopped exploration. So they just leave them on the balance sheet. So it becomes a stranded asset. It's not producing anything. At some point in time, some guy like Rich, he's gonna walk up and chat with his friend Steve and in Vancouver, who's going to sell all of his properties, and then they're going to buy up all these assets that are for sale, at bargain prices, and then start producing again. But again, this is a very long turn to take. Whereas like the financial sector, because again, on the weekend, Kearney says, everyone do that, and they're going to do it. Anyway, but that's a bit of a long-winded introduction into what we need to appreciate of what's happening in the sector.
Can I just quickly summarize that? Rich?
Go ahead. No, go ahead.
And then I'm going to jump over to you. Quickly summarize. Basically, Keith is essentially what Keith is saying, and correct me if I'm wrong here, but basically, Kearney and Co., the sort of global masterminds here, are going to basically try to starve the energy sector of capital. Essentially, it's going to cost them a lot more to borrow money for exploration, etc. And so, if you're sort of an oil producer, essentially it doesn't really make a whole lot of sense to actually go out and search for more oil. You're better off just to basically return that capital back to your investors. But thus, in essence, you could ultimately create a shortage of future oil supply, thus higher prices. I mean, I don't know if that's
from the private. Yes, just to add, in the private sector. Remember.
Well, that's where I'd like to step in. Sorry. Go ahead, Keith. Go ahead. Sorry, Keith.
Yeah, so that would affect, like the listed companies or the private companies are out there, but the likes of the Saudis, Russian oil, and Venezuela, Brazil, Mexico, like those guys are still going to be producing, and they don't care a hoot about what Kearney and the lads are putting together.
You stole my thunder.
Yeah, thunder. Sorry, man. But it is a good perspective though, and everything, right? We really need to sort of square the peg with what's happening. But what else do you see though, Rich?
Well, I think that you nailed it exactly right. I think that the reality is that when I say that there's 96 million barrels of oil consumed per day, this idea that we're going to turn this global energy consumption around, I think, is false. And the reason it's so important what Keith is saying is two reasons. One, the marginal producer, in my view, and I think Keith will share this, will shift to what I would call nefarious actors, people who don't like us, people who are not ranked in the top 10 in democracy indexes or press freedom or women's rights: Russia, Saudi, China, Iraq. And by pulling yourself out of this global market, Canada, which has respect for women and gays and is ostensibly a pretty decent democracy and has press freedom, you are basically transferring the production and the money, and money is power. And it's these policies are an inadvertent geopolitical football that you are taking away from what I view is a country that at least aspires to be a liberal democratic country with socialist values, to a country and countries that have demonstrably demonstrated they don't give a shit about A, the environment, B, anybody who gets in front of the totalitarian people who run these places. And I think it's really, really important that we remember that when we turn our back on such an important commodity. And then to address the private sector thing, the reality is the consumption of oil is not going anywhere. India is 1 billion people. They're going to consume more cars, not less. China They're consuming more cars and more energy, not less. We haven't even talked about Africa. They just woke up. We're, from a developmental point of view, from a GDP per capita point of view, they're only about to start getting onto the energy train. And that energy means oil. And so what you're doing is and to me, why I'm so bullish actually on the energy sector, and I guess I'm speaking my book here, so forgive me for that. And why, I'm saying, and I wrote about I wrote it in a piece called The Crude Light of Day, is that by only attacking the supply and increasing the cost of capital for these energy companies, you're actually inadvertently making them, and perversely, it's a Pyrrhic victory. You're making these companies more profitable. If your cost of capital goes up, you're going to be more disciplined in your capex. And you have a situation where supply will be squeezed, the cost of capital is going to go up, but the demand for the product that you sell is going nowhere. And so it's a sweet spot. And not to mention that all of these pension funds and these large institutions that are captured by the Mark Carneys of the world, you can only sell and divest from those stocks once. So Case the Depot is a perfect example. By the end of 2022, they're going to divest from another 1.5 billion, I think is the number, in oil and energy assets. Once that's sold, once all these pension funds reduce their exposure to this equity sector, you have a situation where supply is going to be squeezed, demand's not going anywhere, and these energy, other than outside of being stranded, I think they're going to be an excellent investment. That's my personal view. Again, it's not investment advice. If you want some, you can pay me for it. But I think it's a really, really, really important. Those two things are really key. And I think and then the other thing, finally, and I have to say this, sorry, I'm really passionate about the subject, is the idea that we're not going to no one mentions nuclear power as the offset, right? I mean, that's the crazy thing. And I just think that that's, for me, I don't know if you guys have views on that last bit, but I just find it outrageous.
I mean, I think, not to get overly political here, but isn't is it new energy minister, Stephen Guillebeau? Is that what he's called, the energy minister? Anyways,
I'm not taking this trap.
Anyways, I'm going to quickly touch on this because just to give you a framework of where I think the politics around that in Canada. I mean, this guy was literally arrested, I don't know how many years ago, for scaling. Was he
CN Tower? It was CN
Tower. He scaled the CN Tower and put signage up, basically saying end the oil sector. Essentially, is basically what he was saying. Anyways, so
he's right. But he's right. Eventually, human beings need to pull themselves away from this commodity. But there's two things. One, it is extremely, extremely useful and is effectively an energy, and the consumption of energy has emancipated the world for. That is what makes us not be 1800s. It's the fact that we have this useful chunk of energy. And number two, no one has presented a viable alternative, and wind and solar are not going to do it. And P.S., they're manufactured in China, and they use coal power plants to power the manufacturing facilities.
Keith, what do you say? What do you do if you're an Albertan? You're like sitting there, Rick from Red Deer.
I mean, you made a good, yeah. I mean, again, like I try to be a bit dispassionate about, you're talking about markets, say, like, just be objective. It is what it is. But you just made a good point, Steve, about the new energy minister. I think it's incredibly important to know that this guy is, he's more or less anti the sector. So that's good to know. As long as you know where the guy's coming from, then there's no surprises with it. But the federal government, they've been very anti-Alberta. They may say they're not, but their actions are. I mean, they are against expanding, improving, or making better pipelines for Alberta to get the oil out. They are also against the tankers as well, going through British Columbia. They've been very slow with that. So no matter which way you push all that together, it's not a great short to medium term outlook for our friends in Alberta. And again, I have lots of friends out that way, so you just feel for them. However, let's imagine a world, for example, where again, this global group, they are highly successful in changing how energy is manufactured and produced. You mentioned the number earlier, Rich. I think, though, if you add some multiples to it, the energy sector will make up about 20 to 25% of the Canadian economy.
Yeah, I was just doing it bare bones, but you're 100% right. Thank you.
If you say that again?
So the Canadian energy sector contributes about 20 to 25% to the Canadian economy. So Canadian GDP, about a quarter of it is coming from out of Alberta and Newfoundland to some extent. But not only is it a huge contributor to the economy, it's a vital contributor, to the economy. As you mentioned earlier, it in terms of a current account, it's bringing US dollars into the country. Whereas everything else, we're importing it in.
Oh, and just for context there, and correct me if I'm wrong, Rich, I think you probably know this better than anyone, but the real estate, the fire sector in Canada, real estate finance and insurance, I think is about 25% of GDP.
Yeah, well, real estate alone is like 13, but it's tough. You have to kind of ignore the COVID blip, but basically it's like 10 or 15%. So yeah,
right. So the energy sector is essentially the same size or slightly larger, basically.
Oh yeah,
for context. Yeah. Anyways,
so what would happen? Yeah. So if that sector is stripped out, and then you have all the nation states who are not going to change their habits, not one bit, the every additional incremental piece of oil, sort of energy coming into the country, it has to come from those players. The cost has gone up. It's higher. It has a bigger effect on lower income families and households, to consume. So it's a pretty big deal we have coming up here. And again, it takes a long time to play out, like an incredibly long time to play out. I know someone mentioned nuclear. I don't know if it was Steve or Rich earlier. Rich, yeah. But it's, again, like energy cannot be manufactured out of a tree. It has to come from so many places. And nuclear, if I'm, rearranging the chairs in the deck, it's certainly one of the main opportunities that Canada would have to go down that road. And but it's only one of the guys on my network I was chatting with earlier. He said, Keith, the number of people who die from building hydroelectricity dams, it dwarfs the number of people who've ever been killed from a nuclear power plant. Right?
I mean, Keith,
sorry, I was going to say a bad name all the time, right? It's a tough one.
Well, I was just going to say, Keith, that if the French can do it, what everyone else should be able to. Just to give some context, France produces 76% of its, or 75, depending on the year, whatever, percent of its electricity production is nuclear energy, and it's one of the richest countries in the world per capita. And I'm just saying, Canada has lots of space. We have lots of uranium. We have loads of engineering students. And it's just a blind spot that I think that people in general just don't. But Keith, back to your point about the families. I think what's really also important, and I skipped it in my spiel earlier, is that Canada year on year is one of the best performing, Canadian dollar, is one of the best performing currencies year on year. And I think it's up about 7.8 to 8% or whatever versus the US dollar. This is at a time when inflation, and I promised we wouldn't talk about inflation this week, but is at an 18-year high. And so just to give you an idea, if we did, just imagine what would have happened if we did not have the shock absorber from oil offsetting the increases in prices in the commodities we don't have and the consumer goods that we import. That's my question for you guys. I mean,
yeah, just to let's use Turkey as an example, right? So Turkey, it's considered to be a developing country or emerging market country. And you say, geez, Keith, you can't compare Canada to Turkey. However, what we're doing here with this exercise is comparing one country who is exporting energy and another country that is importing all of their energy. So with Canada, we're selling oil, we get US dollars coming in, and that's awesome. It's awesome for the economy, awesome for the banking sector, awesome for funding costs, awesome for credit spreads. There's zero bad things associated with that. Turkey, on the other hand, because they have to import all of their energy costs, because those costs are going through the roof, and they do not export anything to get US dollars. US dollars and foreign currency is just fleeing the system. And it's fleeing the system so bad that the central bank is actually borrowing US dollar deposits from the commercial banks. So you see how it's so for listeners, it would be the same as if the Bank of Canada said, yeah, we have we have 500 billion US dollars here to help protect us from anything bad that went on in the world. And then Steve and Rich, they pipe up and say, yes, but Tiff, of that 500 billion, actually 490 of it actually came from RBC, BMO, and the other guys. You just took it from their account. So, it again, being energy independent and efficient and being in control of your own domain, it's incredibly important. And then with Turkey, of course, inflation is double digits. They're struggling over there. The economy is one crisis away from having a run on their banking system and so forth. But it is incredible. Like we have a great country here. A lot of really great opportunities for individuals and households and companies. But it's the energy sector. It's getting a bad rap, and it really shouldn't.
Do you have a directional call on that, Keith? I mean,
on oil, crude oil, or the equity side? I think the equity side is going to be, they have the opportunity to struggle. For crude, we have an opportunity here at low base for it to have a real super spike. And I think I mentioned a couple of weeks ago.
A super spike, but you think equities underperform, basically?
No, I mean crude itself, so crude oil. So, I think crude around $81 here for the WT for West Texas. Again, like back in, I think it was 07, 08. Oh, no, I don't remember the year when it's spiked up to 147, 148. Do you guys remember that from your studies? Because I'm a boomer, right? I was living then.
That was my first job out of uni was June 2008. Yeah. So I watched it.
And what I love about that, so I was offshore then. And so I was offshore for a number of years. And when oil spiked up that high, we said, hey, everybody wants to buy oil. So kind of like today, we have that market, right? Everyone wants to get on oil, and this thing's going straight up vertical. We said, geez, eventually everything runs out of, energy, excuse the pun here. But we have some pretty good models in place, especially with sentiment and momentum with it. We say, hey, this is gonna die out here any second. So whenever you get a market moving, an extremely aggressive movement in one direction or the other, get ready to slowly, put on that opposite play coming up. And so back then, we were running long only equity as part of one of the portfolios. And I remember we did our analysis. And we said, okay, what has the biggest negative correlation to oil prices? And the answer was airlines. It's like American Airlines, those guys. So we had the analyst that covered that sector. We said, hey, what do you think of these airline stocks? And he said, Keith, these are horrible. He had 25 reasons why you should never buy them. And yet we did. We just spread the money across them. And then about 3 weeks later, oil just plummeted. It just dropped from the earth. And on an equity base, these airline stocks went through the roof. So you're renting the airline stocks. You weren't buying them for an investment. So with today's market, I actually love to see oil have this super spike higher. And all of a sudden it becomes the new cryptocurrency. Everyone's in on it.
Yeah, but
and then you just line up, right? You short this thing. So
I think there's a bit of a difference though between 2008 and Keith. You'll correct me if I'm wrong. I think, but I think one of the big differences, I think you touched on it earlier, actually, which was the fact that a lot of these companies for a long time and now have been starved basically for capital. And if you look at the CapEx spend on the aggregate, I only look at sort of aggregate numbers and aggregate figures for countries and sectors. So forgive me if I got this wrong at an individual firm level, but CapEx is way, way down. And basically over the last 3 or 4 years. So unlike, in 2008, where you had the oil boom, but you had a fall, kind of a coincidental and subsequent CapEx explosion, chasing that extra, that $100, $125 oil. Now it's a much different scenario, and you have CapEx in that oil sector is I think 5, 6, 7, 8 year low. And things like you look at the Baker Hughes rotary rig count. Normally it goes a lot. So that's basically the amount of wells globally, onshore, offshore in the U.S., wherever. In Persimmon Basin. Anyways, in North Dakota and West Dakota, and you can see these guys are much, much more disciplined capital allocators than they were in 2008, which is, I think it's different this time. Forgive me for saying that, but
I think well, if you get a long trending market higher, then yeah, that's true. If we get this sudden surge, which is what we had back then, fundamentals don't matter at that point.
Yeah, you're right.
It doesn't matter. Yeah.
Can we add something? I mean,
yeah.
Just to sort of get towards wrapping it up here, but historically, I mean, hasn't a spike in oil prices typically led to a recession? I mean, isn't that Rich?
Yeah, well, I was just gonna say. So on my reasons, I have a list on my whiteboard, and reason, and it's right now I'm still quite bullish. And on my list of reasons to turn bearish, it's energy squeeze. And I think it's tough to say what the cause of the recession is. It's never one thing. Is it real interest rates rising? Is it Iranian revolution? Is it this or that? Who knows? But I think there'd be a lot of my former boss, who's a really smart guy and someone I respect a lot. He would argue that that's one of the big contributors. I don't know what Keith's going to tell us what he thinks in a second. I think it's definitely a factor. Energy is the most important commodity in the world, and you can't live without it. And if it squeezes out the purchasing power of all the other goods and services, I think it definitely contributes to slow down.
It's essentially like a tax.
Yeah,
like a tax on the sort of lower middle class, basically.
Yeah, in an environment where inflation's already pretty high. So sorry, Keith, go ahead. Sorry.
No, I mean, again, like the last point, like from a market perspective, markets and economies can adapt very easily to any long-term trend in any direction. It is these sudden spikes higher, and it doesn't matter what caused it. You get a spike higher or lower in anything, that's going to affect the economy, especially something as important as energy prices. It's absolutely going to affect the economy. And, as we talked about before, the global economy is just, it doesn't look like it should because of all the, the supply chain disruptions, you got, economies are shut down, then they're back on again. And you can do this or that. And the cost of funding is cheap for some and not for others. Any sudden spike in energy, it's going to play out somewhere here in the market. And, so the final thing we all need to recognize that there's just still way too much complacency right now across all markets. And people say, hey, what will cause the complacency to disappear? And my answer is it doesn't matter what causes this. The fact is something will cause it. Maybe it's oil. Maybe it is.
So summarize, God bless Canadian oil. Let's jump into the mailbag because we actually got a question here from Over Easy. Looks like he's got a picture of an egg here on Twitter. He's asking how integrated are Canada's energy markets with the rest of the world? More importantly, he wants to know, should we expect our natural gas prices, home heating, to explode higher as it has in the UK/Europe?
Can I take this one? So at the risk of, so I'm going on a limb here. The natural gas thing is, I think, a hyper localized market, and Keith will correct me if I'm wrong, or the people in the comments section surely will. So when you look at the 5x increase in the natural gas prices in London and Netherlands and parts of Europe, etc., it's a function of two things, I believe. One is that they don't have very many terminals, number one. Number two, they get all their natural gas from Russia, and Russia's put the squeeze on. I mentioned this before, why it's important the nefarious actors don't control all the oil industry. So the natural gas is quite a hyper localized thing. Whereas for us, it's something called the Henry Hub. And it's basically out of that sort of index drives Canadian natural gas prices, and that's in the US. And you'll see it hasn't risen anywhere near as much. And then as far as the other question, which was is our oil industry integrated? 97% of our oil goes to America, 96, 97, whatever it is, out of the 4.4 million barrels per day. So we're extremely, extremely integrated to the US market and not so much integrated into the other parts of the world. However, US now. So, but that doesn't include things like refining and then all of the products that come from petroleum. So like contact lenses, your computer, the microphone, artificial vanilla extract is a petroleum product. Do you know what I mean? So, when it comes to those kind of second derivative things, I'm sure it's much more integrated. I don't know if Keith has
No,
Keith's not.
I wish I could just say all that again. That was really good.
I got another question here from Mayor. Anyways, he's asking, with the majority of Canadian mortgages 5-year fixed or less, unlike the US, which will allow you to lock in that rate for 30 years, doesn't that make Canada extremely sensitive to rate hikes or increases? Essentially, he's saying is it's not like having teaser rates like they did in the US in 2005. I mean, my personal opinion is, and Keith, maybe you can touch on this after, but my personal opinion is I think that that's always been the biggest risk in Canada, is that you do have a five-year reset, right? And even if you have today a situation where, okay, you just locked in a 5-year mortgage at 1.5%. I mean, even if that goes to 3% in 5 years, I mean, that's basically a doubling in your mortgage rate. And when you have a highly levered housing market, highly levered private sector, I think that, yes, that's not necessarily going to result in a wave of defaults. But I think what happens is when your mortgage rate basically doubles on your renewal, I think that becomes a drag on consumer spending, right? I mean, consumer spending in Canada is 65% of GDP. So I think people have to sort of, quantify that. But Keith, I don't know if you have any sort of closing thoughts on that.
No, I agree with exactly what you said. So, most mortgages are 5-year terms, I think, here in Canada. A lot of them are fixed rate. So 5 years from now, people are going to have a shock with their mortgage payment. And it takes away from your discretionary spending opportunities elsewhere.
Just a question: is that still your personal view? In 5 years, like, do you envision a world where rates are meaningfully higher?
Yeah, absolutely. I think the low end, so overnight rates, I don't think they're going to go up at all. As we mentioned a couple of weeks ago, they might go up 1 or 2 points. By that I mean like maybe 0.5%, and then they'll have to stop. It's the long end of the curve, what everyone has to worry about in the mortgage world. I don't think so. We'll get to 5 years. I think within 5 years, I think the financial system will look shockingly different than it does today.
So you're telling everyone to go variable?
Yeah, I mean, I don't know. Rich has a home over in, is it Chelsea? Where's your house?
No, I wish. Chelsea, I wish. North London, mate. It's North London.
Rich, London deals with the same problem, right? And I think that's what with Boris there. He's trying to create like a new market for longer duration mortgages.
Listen, if we've learned nothing from the last few years, is that house prices never, ever, ever go down, and you should just borrow as much money as you possibly can. No, I'm obviously kidding. I mean, I can't speak to the new thing with Boris. I just know I'm very conservative, so I want certainty. So variables are not for me, but I don't know. I can't speak to that. I'm sorry. You got me.
That's a wrap. We'll end it there. We'll leave people hanging with uncertainty. As always, we'll be back for next week's episode 5. We're rolling on your episode 5 of the Loonie Hour. As always, hit the thumbs up, subscribe. If you can write us some reviews on Apple Podcasts, Spotify, we will greatly appreciate it. Push us up in the algorithms. Let's get some more educational content, different voices out in the Canadian sort of financial landscape here. Appreciate the support.
And Steve, if people were interested in some of those charts that I've got a lot of them. So just reach out to me.
Slide into Rich's DMs and let's make it happen. We'll see you guys next week.